I think this arbitrary turning over of the calendar from one month to another is not actually significant for professionals managing money. And I want to build on something Joe said, which I think is the biggest takeaway. I decided sometime after Memorial Day that I was not going to be one of the people running around with my hair on fire every time the president sent out a tweet or Chinese media put out a counterpoint. I said, you know what? I'm gonna have a hot girl summer. I'm gonna focus on me. I'm gonna read some books. I am not gonna be out there flipping open my laptop to swing cash back and forth. And here's what happened if you chose to ignore all the histrionics of this summer. Summer started on June 21st. Take a look at a 60-40 portfolio, 60% VTI, which is Vanguard, total market, stock market, and BND, which is total bond market. By the way, this portfolio is essentially free, a couple of basis points. If you did nothing and just owned that, you're up 0.68% for the summer. So that's how you're going into Labor Day. All of the tension, all of the screaming and yelling and VIX spikes, et cetera, et cetera. So you didn't make a ton of money, but you're up. You're fine. It doesn't matter. And I think that that's been a really a good posture to have when we now have elected leaders who can swing the Dow Jones by 600-700 points on a tweet. Like, if that's the environment we're in, the answer is not, let me guess when and what the next tweet is. The answer is what Joe is saying, stay diversified.
Do you want to have that 60-40 portfolio?
100%, and I'll tell you why. Because a year ago at this time, and I looked back, we were going into Labor Day 2018, and the royal we were absolutely certain that rates were going nowhere but higher. Jamie Dimon said, look out, could see 5% plus on the 10-year. It's a year later, and now we're saying Treasury's going to 0%, if not negative, to follow Europe, and we are almost as sure about that outcome, combined with more Fed funds rate cuts, as we were a year ago about the exact opposite. The Fed has to raise rates behind the curve, wage growth, et cetera. So which is it? It's probably neither. Neither of those extremes probably plays out. And so when you have a diversified portfolio, you may not look like a genius every day, but overall, the risks, the rewards, they will balance out. And this is a rational course of action in an irrational period of time for the investor class, the political class, et cetera.
So I agree with part of Josh, and I disagree with the other part. The part
you're wrong on the part you disagree with.
You're wrong. So the part that I disagree on is the 60-40 portfolio, because for me, it's really hard to think about putting any money into bonds right now. And when we see this like $6.4 billion of bond inflows in the last month, like I don't know who's buying bonds. I certainly wouldn't want to buy bonds when I've got a 1.5% yield on the 10-year Treasury. The part that I totally agree with you on is, in a nutshell, what you're saying is control yourself. Use discipline, be disciplined, stay focused, tune out the noise. And I think that especially in this period where there is so much noise and it's so external, and it's almost, to me, it's almost like how I felt in 2015 when I was waking up every morning and checking the oil markets and you had no idea what was coming your way. That's what this round of tweets is like. You have no idea what you're going to wake up to. And the best thing you can do for your portfolio in the long term is focus on the long term and keep control of yourself, and don't be getting in and out and all over.
Can I ask you something?
Sure.
Do you know that there are European bond funds where a year ago people would have said, how can you buy European bond funds? Rates are negative or going, that are up 30 to 50% year to date.
Okay, well,
hold on. On European sovereign bonds that nobody in a million years would have said, these are a buy, these can go higher. Capital appreciation in European bond funds has screamed to the upside. You could say, I don't like it, the ECB is manipulating it, Lagarde's going to be even worse. You could do that whole dance, but you have still made a lot of money in that asset class when the conventional wisdom was there's nowhere to go.
30 to 50%
in specific European bonds.
But
yeah.
in any case,
wait. Are you talking about like Greek bonds?
All over the continent. Take a look.
Are you talking about German bonds up 30 to 50%?
No. Bunds didn't have that far to go.
No, but let's put this into perspective. You're not getting 30 to 50% on bonds.
Not adjusted for currency. Not adjusted for currency. Greek sovereign bonds now trade at a lower nominal yield than U.S. Treasury.
Yeah, great.
You could say it shouldn't be that way.
Look,
I agree. It is that way, and
Josh,
people have made money in that asset class.
Josh, I'm going to call negative yields what they should be called. Semper Augustus, okay? And I think you know what I mean by that. Semper Augustus was the name of the most expensive tulip during the tulip mania in Dutch, back in the 17th century Netherlands. That's what we've got going on with bonds right now. Anybody buying bonds at negative yields, now I'm talking about negative yielding bonds, anybody doing that is saying, I'm going to sell these bonds to a greater fool than me.